Welcome to another episode of Commercial Property Roadshow. You're here with Helen Tarrant, and today I'm actually going to take you through some calculations on my whiteboard. I just did this on the webinar yesterday, and I had 166 people turn up to the webinar. So I kick off the year and give you some predictions for the year and letting you know what it's like if you bought in the market at the wrong yield. We're going to see some really interesting deals come on the market this year in the commercial property space, and we're going to see some people paying over market for these properties, and we're going to see people buying at really extraordinary low yields. But I want to show you what happens to your equity if you bought wrong, and I'm going to show you what happens and how you can insulate yourself against a market downturn. It's really important now to safeguard your equity and your money more than anything else. But remember, fortune favors the bold. And if you don't go out there and search for the deals other people are not looking for, you are not going to get the rewards other people are not going to get. So basically, you have to be able to take risks where other people don't in order to really reap that reward, especially in a couple of years' time. And how do you do that is a matter of having the right mentorship, the right people and the right team surround you, as well as knowing the strategies and how you could go wrong. So let me show you on the whiteboard, and let me show you a little excerpt out of my webinar of how I worked out and where you should be positioning yourself. Oh, whiteboard. I'm a whiteboard.
Yeah, fabulous.
Fabulous. Okay. So we're trying to work. So this is an example. We're going to use round numbers, right? Say you're buying $1 million, and this is literally what we saw last year. Like we saw people in places like Rocky or even Townsville and Cairns, people really buying lower than yields. What I'm saying is, I'm seeing listings in Townsville at the moment at 6%. I'm seeing Rocky at 7%. I know that last year someone bought into Rocky at 6.3%, right? So let's say you're buying $1 million property. Right, this is your $1 million property. You're going to need, let's say, 35% because you're doing the lease stock loan. So let's, for this moment, take away all the stuff you have to pay as stamp duties, costs and stuff like that, because those are fixed regardless. So we're just looking at the pure equity. So that's really $350K, right? So we're looking at this $350K. If you bought something at, let's say you went into Rocky and you bought it at a 6.5 or a 7 or below that, but let's just say that it's been a 9% town for years and years, and at the moment with all rising markets, it's actually started to move and the yield is starting to come down. Let's say you buy a 7% property in Rocky, and this is just an example, and there's many towns that we're seeing out there that is doing exactly the same thing. Like we're seeing crazy buyers buying anything, right? So this is just a pure example. So that's $70,000 net rent, right, that you're seeing. And
so people can just see you in the little corner there too if you need to.
Ah, cool. All right, so $70,000 in net rent. And what happens is that when you buy this $1 million property, you're putting in $350K, and you've got a loan of $650K, right? So that's how the equation works. Now on that you're going to pay interest, so let's always benchmark this at 3%. So 3% or 650K, not a huge amount. Work out roughly how much that is. 18,000, we'll call it 20,000 or so. But what happens when the market actually corrects itself? It's probably going to look fine in the next 2 years when the market is on a rising market. You're going to see yields compress. You're going to see that something in Rocky that's at 7% probably go to a 6.5%, and all of a sudden you think, oh, my property is going up, right? So it's going great. But what happens when regional actually corrects itself? I mean, when it corrects itself across the board. So you're going to get the correction in metro as well as in regional. But what happens if something like that corrects itself and all of a sudden that it goes up, so your yield suddenly becomes 9%, but actually let's say not even 9%, let's say it just corrects itself, because normally when it corrects itself, it corrects itself a little bit. It doesn't quite go back to original state, but it will correct itself to potentially 8%. So So now your property that's at $1 million, and let's say that the rent in the years that you've had has not changed much. I mean, there has probably you probably had a CPI or a 3% increase. So your year one, you've had 70K. Year two, I have to calculator out and work this out. 72,100. That's a 3% increase. And so that's sort of if this is correct and the market yield stays. So if yield stays at 7%, your property here you bought it in $1 million, your property here is worth $1,030,000, right? But if the market corrects itself, so instead of it, then the yield changes. So the yield changes to 8%, so which is where we're here, and your rent is 7,200. You have 71,200 divided by, now at 8%, the value of your property is out at 890k, right? So if the market corrects itself in the second year or in 2 years time, all of a sudden your 72,000, your $1,030,000 property drops and it's now valued 890k. Now what happens in that instance is that you have a borrowing still on it of 650k, but what you essentially have lost is the part of the deposit or the equity you've put in. So you've lost on paper, obviously, if you're looking at the 1,030,000, and it's gone down to, you've lost 140k. But if you look at the actual real deposit that you have lost is 110k. So you've lost 110k in your deposit. Now, in a market that is somewhere like a Rocky or somewhere that can go flat, so more inland properties or certain areas where they have smaller populations, what we're going to find is once it goes flat and once the yield changes and if the yield goes up, the value drops, it actually goes flat sideways for quite a few years. And that can be even from 5 to 7 years, that going flat with a little bit of fluctuation, but it's going to take you a long time for you to even recover that 110,000. But then what's a flow-on effect is that at some point, let's say your tenant's on a 3 or 5 year lease, at some point you're going to have to refinance. And at this point, when you refinance and you have a lower valuation, right? And that results to, let's just say that your property stayed at $890,000. The bank is going to take the current value and they're only going to lend you 65% of it. So that means they're only going to lend you now 578,500. So you may be in a situation where they ask you that you have to top up your loan by 71,500. So not only have you lost your equity, you may be in a position where you have to actually top up your loan. So that is the scenario that can happen if you're buying into the market the wrong yield, which means too high a price, not enough yield. Now, you rather wait for the right deal to come along, or if you're in an area where you're going to be outbid and it's the wrong yield, sometimes that can be as much as just 1/4 or 0.5%. It's better to let it go. And that's just the scenario of what happens if the market corrects itself. Now, every time the market corrects itself, it doesn't correct itself back to original. So we've seen, so for example, 2012, when I bought into Sydney, we bought into Sydney around close to 8% yield, right? The market has gone down, it corrected itself, and it went back up. But the thing is, it went to as low as 2 to 3% in the height, and then it corrected itself, and now it's corrected itself during COVID. Some of the properties have corrected itself, it's gone to 5, but it's never going to go back to 8 again. At some point, in some properties, it will correct itself to 6, then it won't go ever, and then you'll go back down again and probably equalize somewhere around 4.5%. but it will not go back to 8%. So if you bought in Rocky and you bought, say, 6.5 or 7%, the market may correct itself. May correct itself to 8, may correct itself first to maybe 8.5, and then after a little while might equal itself out at 8%, right? So that may be the end of the conclusion. So for us, in order to stop that, what we do is we look at what happens when the market actually corrects itself. Everything is going to correct. It's just how you insulate it when they correct itself. So we benchmark it on what, based on doing commercial deals in and out every day, living, breathing commercial. What is the correct yield if the market corrects itself? And that's what you need to think about, is that am I buying in the right yield, not only in this current market, but what happens when the market corrects itself? So 8% is our benchmark for Rocky, right? If we go something that is 7.9, 7.85, and it's a tenant that has a 5-year lease on it, yeah, absolutely, we would do that deal, right? Because I know that in 5 years' time, it will wash itself out, right? But if it's a 7% yield, even if it might be a McDonald's or a Subway, or even if it's a warehouse, I probably still wouldn't do it in Rocky, because the risk is too high if the market corrects itself. Now, at some point, even if you bought in at 8%, when the market corrects up to 8.5, you might still feel, oh my God, my property has devalued. But remember, that's a paper value. As long as you don't go for refinance and revaluation during that time, and you let the market wash itself out to where it stabilizes, you will still be fine. So that's how you insulate yourself. And that's why I keep saying buying at the right yield is really important. That's what I'm saying, because when the market corrects itself, you want to make sure you're on the right side when you insulate it. So this is the scenario, and then I'm going to share with you. So let's see what happens in something like a metro area. So in metro, we look at the same $1 million property, right? I'm talking things like, well, this is Brisbane. Let's talk about Brisbane. Let's not even talk about Sydney or Melbourne, because at the moment the yields is still unstable in Sydney and Melbourne. We're not, because of COVID hitting Sydney and Melbourne probably harder in the CBD area and the fringe, harder than it has hit Brisbane and Queensland. We're still stabilizing. There's still properties being sold at 3 to 4%. In Sydney and Melbourne, there's probably being sold at 5 to 6%. So it's still fluctuating at the moment.
And I think, frankly, in Sydney, if you're spending $1 million on a property, you'd end up with a parking spot.
Oh, come on. 2 parking spots.
Oh, silly me. That's a joke. If anybody's new, that's a joke. 2 parking
spots and a storage cage.
And a storage cage. Oh, there you go. That makes up $1 million. No, it doesn't. That's a joke. Anybody who's new? Shh, joke.
So this is what happens in metro. So say, for example, Brisbane at the moment, this year, where I think Brisbane will go is, I think the yield will go to a 5%. That's where I think it will close out at, potentially even lower than that. I could be wrong, and it could close out at 4.5, right? But I'm hopeful that it will stop at 5 and doesn't go any lower than 5, because any lower than 5, well, you might as well be buying in Sydney, right? There's no point, right? But I think at some point it's at 5. It's going to go to 5. So at the moment, the way that I look at it is that if you're buying at 5, you're buying it at too low in Brisbane. Unless this property has massive development potential, you can tweak the rent and you can bring that up in a short space of time, with its 12 months time. Buying at 5 as a set and forget is way too low. I don't care what kind of property it is, it's still too low for me. And that might make me really, really picky, but it's the properties that we reject that makes us the best, right?
Yeah, and thank God we've got a couple of lawyers on board, because we're just about to get sued by John West. Well done.
So
everybody, buy John West salmon. John West, please don't sue us.
So what I like to benchmark here is about 5.5 to 6%. Now, the reason I talk about this at this sort of level is that we're going to see a lot of property listing around 5.5%. And depending on the type of property and the type of lease, if the lease is long enough that can bypass the next couple of years correction and let the market wash itself out, then buying at 5.5% does not mean that you're actually buying above the market. Obviously, we like to do a little bit better. So if we can do a little bit better, we would. So that's why we always say we like to buy something in Brisbane between 5.5 to 6%. Because what will happen here is that market will go down to 5, and then it will equalize. It will go up to 5.5, and then it will stay at 5.5 for a little while. And That's where I think it will, because what will happen is that Brisbane, if you look at historically, you got to look at historic data. It's always sat at least minimum 1 to 2% above Sydney and Melbourne, right? And while Sydney and Melbourne are fluctuating at the moment because of this confidence in the market, and a lot of people from Sydney and Melbourne want to buy in Queensland, there's that fluctuation, which is also an opportunity. So if you can see the opportunity in between all of that uncertainty, that's where, that's the best time to pounce. But if Brisbane, once it hits 5, most people are going to exit that city because they're going to go, well, I might as well be back buying in Sydney or Melbourne for 4 or 4.5%. 1% is not going to incentivize someone to give up the capital growth they can potentially have in Sydney and Melbourne. When you get to that level of 5%, we're looking at a capital gains equation on top of cash flow. At 7, people can forget about capital growth for a while, but at 5, people want to think there is capital growth. So, and that's just the way the market works. Agents hope it's going to run forever because they've had some spectacular sales, but it is not, because the economics and the metrics behind it isn't going to allow for it to happen. So what we will see now is, for example, if you did buy on market at 6%, right, or even 5.75 or things like that, what we're going to see is that it's 60k net rent. So 60k is your net rent, and pretty much you're putting in 350k, and so it's the same deposit, 650k in the loan at 3%, same deal as you would do in Rocky, as the previous example is. What we're going to see in this scenario is pretty much the same thing that will happen in the market, is that at 6% you're able to afford and make probably on $1 million, probably at $30,000 in passive income. And what we'll see is that year 1, you're going to get 60k. Year 2, we're going to put a 3% rental increase in there. So 61,800. Right, so the value of that is 1 mil. What we're going to see in year 2 is that at some point we are going to see the market go down. So yields are going to go down, value is going to go up. It's going to go to 5%. So that's 1,230,360. Right, and then potentially within that 24 months time, that will allow for 1 rental increase again. So we've budgeted for everything else. The market, so that's at 6%. That's 5%. The market will correct itself at 5 to 5.5%. Right? I will actually, for the sake of this, I will take that out and just do. You will go to 5.5%. And the value of your property is going to be sitting somewhere there in about a 2-year period. So you will still get some capital gains in a fluctuating market, right? If you bought in at 5.5, you'll find the property will go up, and then it will stable itself there. And what you'll see is you'll get gradual rental increases over the next few years. And the market will essentially stay flat and you have a little bit of capital growth. That's what you're going to get a scenario in buying in metro areas. Now, when the gap between metro and regional closes in and you're going to have 1% or less, I typically like to bring my clients back into more metro areas. Yes, you are going to get less returns, but the thing is, it actually insulates yourself against the risk of fluctuating markets and a downturn in the economy. Now, what in investments, there is actually a couple of things to think about. In commercial, it's a cash flow driven game, and a lot of people now are chasing cash flow coming from the residential space. Is going to go cash flow, cash flow, cash flow. But in a seller's market, when the sellers are there selling and they're getting top dollar for their sales, what you actually got to insulate yourself is actually the risk of the market correcting itself. That is a greater risk than really going out and going, I'm going to seek for the extra cash flow. You've got to now consider, all right, if I just insulate myself against that fluctuation, then once the market flattens out, I will still have some capital growth. I can still leverage off it. I'll still get some cash flow, be a little bit less cash flow, but I'll still insulate against it. and I'll be able to do my next deal. Whereas in this space where we talk about Rocky, if the market like that corrects itself, you will not be able to do your next deal. In this deal here in the metro space, here what we're seeing here, you are still able to do your next deal. So let's look at that. In year 2, where you might have bought 1 mil and you've got at the end of year 2, or let's say you get a 3-year loan, at the end of year 3 where the rent's gone up a little bit by 3%. The yields are stabilized at 5.5%. You're at 1,157,345. That's that's the value of your property at the end of 3 years. You can refinance at 65%, which equals 752,000. All right. So it's not a huge amount. It's only about 100K. So at 100K from your first initial loan when you refinance it, it's not a huge deal. But in a time where the market corrects itself, this is actually the best case scenario for you, because in this scenario, you're actually doing better than the market, because most people have taken a hit because they bought in areas like, and I'm using Rocky as an example. I mean, there's lots of areas last year that I've seen people crazily buy, and we've just pulled our clients out. Sunshine Coast, a perfect example of that. There's certain areas in Melbourne Fringe, we've seen that. Certain areas in like Sydney Inner West, we've seen like properties like warehouses going for 2.8% yield. I mean, nuts, right? Sunshine Coast, you can sell anything at 5 to 5.5%. Probably going to go to 4.5% by the end of this year. So we've seen obviously big, large regional areas. We've seen Harvey Bay boom. We've seen Townsville boom. We've gone through that boom, and I've seen listings beginning of this year in the 6s for them. We've seen parts of Cairns. There's no industrial in Cairns nearing even 7% last year, which is crazy, right?
Yeah.
So the best case scenario is actually this scenario when the market corrects itself. So when I say that fortune favors the bold, what I'm trying to say is that if you actually know what you're looking for in this market, you can actually put yourself in this situation where you're insulated against a market downturn. And for all of you guys here on this call today, you should congratulate yourself for actually turning up and being here, because this knowledge, the rest of the market out there, people aren't aware of, right? And they're going out buying blindly and following other people and buying just because they feel like, they're suffering from FOMO, right? But if you know this, these are the metrics, right? And then when you look at regional properties, you can go, all right, well, that's the conversation I had this today was, I don't think that property is going to do well in an open market. Right, so let it go to an open market, let it correct itself, and then I'll be ready to buy. Right, so this is where I think the metro scenario at this moment, and also if you're in regional, what you want to do is, if I can get my screen back, here in regional, if you did end up at an 8%, if this scenario was to, if you did sort of say we're buying into Rocky at 8%, you'll see that the market will go to a 7%, and then it will correct itself to 8.5%, and then it will go back to 8%. So where you are sitting, you're insulated, right? And what you want to do at the best of times is that you want to actually look at refinancing here. Where the not refinancing here. You want to refinance when the markets get to 7%, and you do not want to refinance here, right? So you need to work out where the market is and launch your refinance at that time, because that's the time where you can potentially put a loan together around 2 to 3 years, where you can bypass the market going sideways in regional. And if you refinance at the right point where the valuation will get you the top dollar, you can still pull out that money and insulate yourself by diversifying your portfolio. Right, so that's a slightly different strategy, a little bit more riskier, but you diversify your portfolio. Together, you've got more sustainable power. Right? And so the regional strategy is a little bit different, and then you got to match up your second deal with your first deal, and etc. Like that. So what does everybody else think? Where are we?
Does that make sense to everyone?
Yes, does that make sense to everyone? No.
Either the internet's crashed or you fried everybody. Ah, there we go. Sure does. Well done. Yes.
So I think the thing is, if you know those metrics, it doesn't matter if you get a property at 5% in Brisbane, as long as you know that as the market is changing, you can actually engineer cash flow to get to your 6% yield, right? So this is where I talk about taking a little bit more bolder, because if you bought a 6% yielding property, you might probably pay $1 million for it. But at a 5% yielding property at that time, you probably pay $900 for it, right? Or a bit over $900 for it. But if you can engineer it to 6%, then you've already made your equity. The other alternative, there might be people, you might be buying a property that other people don't want to buy at 5%, right? The market's going, well, it's not worth 5%, but you could find something, or we have the expertise in-house to really look at it and go, this property has some other potential that you could repurpose, redo, and with some of your own effort, time, and energy, you could turn that into a 6% yielding property, 6.5% yielding property where other people are not seeing. You got to see what other people are not seeing as well, which just takes time and expertise in this market. But there are deals out there that you know that you have to repurpose the tenant. You know that you might have to kick out the tenant. You know that one tenant's paying too low a rent. There's going to be tenants that's going to pay higher rent. Or alternatively, that if you swap out the tenant, the new tenant's going to pay more rent. Or that if you do the extension at the back, you're going to get more rent. All of these things, move an ATM, change a large place into two. These are the things that we're doing before, but there's going to be more demand for you to do that right now to get ahead of the market. As it becomes a seller's market, your biggest challenge is that you actually unfortunately have to work harder for your yield, and everybody has to work harder. And we have to be there for you guys more to help you monitor and mentor you through that process.
All right. Do we want to unshare you?
Yes, we want to unshare me.
All right. How do I do that? I think you have to unshare yourself.
Oh, do I? Oh, hold on.
Just leave top left.
Oh, I just leave. Well, thank you guys. We'll see you in a fortnight's time for our next webinar, and we look forward to bringing you more live updates and information about the current market. So until then, keep hunting. If you need us to help you, drop us an email.
All right, and whoever asked for a link, please send an email to Helen at commercialpropertycashflow.com.au, because I hope this year will be the year where she got a shorter email address. Everybody, have a happy new year. Shin Yan Kwai Le, or if you want to make Helen cringe, Kung Hi Fa Choi. And have a fabulous evening. Talk to you soon.
Bye.
Bye.